This is a lecture for Chapter 6, and this is a continuation of our discussion of inventory. At this point, we're going to focus our attention on the various costing methods that are used to cost inventory. For the most part, we're going to be concentrating on goods that are mass-produced. First thing we need to do is make a distinction between a retailer and a manufacturer in terms of classifying inventory. As we said before, a retailer is buying finished goods from suppliers that they're turning around and selling to consumers. However, with the manufacturer, they are taking raw materials and they're converting them to finished goods. And those finished goods are then sold to customers. But there's one account in between raw materials and finished goods I think we need to consider, and that's work in process. Work in process inventory are partially completed units. So as the production process continues and those units become closer to completion, there will be more cost added to those units. We've talked about the difference between a perpetual inventory system and a periodic inventory system. And in this slide, we're looking at the physical inventory taking. So in the perpetual inventory system, we're checking for the accuracy of the inventory records. And remember, we're talking about computers, and that computers are not necessarily infallible. And then the second reason is that we have to determine the amount of inventory loss due to wasted raw materials, shoplifting, or employee theft, or in the case of a grocery store, things like spoilage in the produce department and also the meat departments. And the biggest source of shrinkage, which is what this is, or inventory loss, is employee theft. And of course, we know the reason for that is that the employees know how the system works and they know how to circumvent the system. For a periodic system, recall that we cannot determine the inventory amount unless it is physically counted. And as a result of that, we cannot determine cost of goods sold until we have a handle on ending inventory. All right. So, what does it mean to take physical inventory? First of all, it requires counting, weighing, or measuring each type of inventory on hand. And depending on the type, will determine whether or not we count, weigh, or measure. Companies often take inventory when the business is closed or is slow. And in most cases, the business has to be closed in order to take that inventory, and it's typically done at the end of an accounting period. So now here's a challenge. How do we determine who owns the inventory in order to determine the inventory amount? All right, so we have goods in transit. So those are goods that have been purchased but not yet received, or goods that have been sold but not yet delivered. So if you look at the box there, it says goods in transit should be included in the inventory of the company that has legal title to the goods. So if we go back to our discussion in Chapter 5, we talked about FOB shipping point. The legal title to goods passes from the seller to the buyer when the seller hands over those goods to the shipper. And as I mentioned, as examples, UPS and FedEx. So in that case, the buyer should include those goods in transit as inventory. If we look at FOB shipping point, legal title does not pass until the buyer actually receives the goods. So in that case, the seller would include those units in inventory until the buyer receives them. And this is just a reiteration of what I had said, and this is also related to a slide that we looked at in the prior chapter. Okay, so now we come to consigned goods. All right, so what are consigned goods? What happens is that there is a business that holds goods of other parties and tries to sell the goods for them for a fee, but without taking ownership of the goods. So consigned goods would be reflected on the books of the owner of those goods, not on the parties that are trying to sell those goods for the owner. All right, inventory is accounted for at cost. It seems simple enough. However, most of the goods that you and I consume are mass produced. Goods that are mass produced, we have high volume and identical goods. So if we think about the cost principle, the cost of an asset includes all expenditures necessary to acquire goods and to place them in a condition ready for sale. This also applies to fixed assets, which we will see when we get into Chapter 9. Next bullet, unit costs are applied to quantities to compute the total cost of the inventory and the cost of goods sold using the following cost methods. We will spend a brief amount of time on specific identification because that's used for low volume, high cost units, and those units are typically customized. First in, first out, last in, first out, and average costs are used for mass-produced goods. Alright, so we have an example here. We have Crivets TV Company purchases 3 identical 50-inch TVs on different dates at a cost of $700, $750, and $800. During the year, Crivets sold 2 sets at $1,200 each. These facts are summarized below. So we can see the purchases and then we can also see the sales. If Crivets sold the TVs that purchased on February 3rd and May 22nd, then this cost of goods sold will be $1,500 and the ending inventory is $750. So we're using the specific identification method because we can identify which particular TVs have been sold because we have low volume, high cost. Alright, now for specific identification, actual physical flow costing method in which items still in inventory are specifically costed to arrive at the total cost of the ending inventory. Alright, then the first bullet says this is relatively rare, and that is true. That a couple of examples where specific identification could be used is, let's say, a customized order for a piece of jewelry. That the customer knows exactly what they want, how they want it designed, the materials used, and that it is not something that is copied. Or if you think about Boeing, they do not mass produce airplanes and have them in a showroom because those airplanes represent millions of dollars. So therefore they're not going to produce the airplane until they have a signed contract from the military or an airline. Because it's a very expensive item, then they are able to identify and trace the cost to the specific airplane. All right. The next slide shows you, based on an average, the percentage of companies that use each of the different cost flow assumptions or cost flow methods. So if 45% use FIFO, 24% use LIFO, 16% average cost, and 15% other. Now we know that specific identification is included in that other, but we don't know what else could be. All right, so what we have here is an illustration. We have Houston Electronics Astro condensers. We're given beginning inventory. We're given individual purchases. Then what they do is they come up with the total number of units available for sale. They have the unit cost for each layer of inventory, and they calculate the total cost. Then they show that the units in ending inventory are 450 units, so therefore 550 units have been sold. Alright, so now let's look at this example from the point of view of first in, first out. And for our purposes, we're going to assume inflation. In other words, for each purchase, we're going to assume that the purchase costs will go up. Alright, so as this slide indicates, the cost of the earliest goods purchased are the first ones to be recognized and determine the first one sold. So the first ones in are the first ones out the door. So depending on the product, this often parallels the actual physical flow of merchandise. Companies determine the cost of ending inventory by taking the unit cost of the most recently purchased units and working backward until all the units of inventory have been costed. And really the easiest way to go about this is to calculate the ending inventory under each method. We know that we will have derived the cost of goods available for sale, and that'll be the same regardless of whether we use FIFO, LIFO, or average cost. And once we have the ending inventory, we can subtract that from the total cost of goods available for sale, and that will give us the cost of goods sold. So as we refer back to the original data that we were given. Alright, so first in, first out. We have ending inventory of $5,800 and cost of goods sold of $6,200. So if we go back and look at this, we're told that there are 550 units sold. So what we have to determine is which 450 units are left over in inventory. So it would be the 400 from the November 27th purchase and 50 from the August 24th purchase. All right. So now if we look at this, they've calculated the cost of goods available for sale, which will be the same regardless of the method that we use. So we have 1,000 units available for sale with the total cost of $12,000. So the total cost of goods available for sale is $12,000. All right, so now we go to LIFO. In this situation, the assumption is the last goods purchased are the first ones sold. And the actual physical flow of goods could be that way. So now, once again, assuming inflation, the cost of goods sold will include the most recently purchased items at the higher cost. The ending inventory will include the older units at the lower cost. And what that will do is that LIFO will produce a lower profit than FIFO because cost of goods sold is higher under LIFO. Alright, so in this situation, we're going to have ending inventory of $5,000 and cost of goods sold of $7,000, which is consistent with what we had said before, that LIFO will give us a higher cost of goods sold than FIFO. Right, average cost ultimately will give us figures that are approximately halfway between the cost of goods sold and the ending inventory for LIFO and FIFO. So the first thing that needs to be done is we need to come up with the average cost per unit. So we're going to allocate the same cost to each unit sold. To do that, we'll take the total cost of goods available for sale and divide by the number of units available for sale. So then, in order to come up with the ending inventory, we would take the average cost per unit and multiply by the number of units left in inventory. Alright, and they show us here in this illustration, they show us the calculation for the average cost per unit, which is $12. We have 450 units left over in inventory, so our ending inventory is 5,400. We subtract that from the total cost of goods available for sale, and using the weighted average cost method, we get a cost of goods sold of $6,600. Alright, so financial and tax effects of cost flow methods. In this slide, we have a list of different companies and the inventory costing method that they use. We have an example here with Houston Electronics. So we have the same fact pattern in terms of sales revenue, in terms of total cost of goods available for sale. And if you look, FIFO has the highest ending inventory, which gives us the lowest cost of goods sold and hence the highest profit. LIFO gives us the lowest ending inventory, the highest cost of goods sold, and the lowest profit. And then the average cost gives us something in between. And once again, remember, the assumption is inflation, which means with each subsequent purchase, the cost is going to increase. So now, let's look at this. Balance sheet effects. A major advantage of the FIFO method is that in a period of inflation, the costs allocated to ending inventory will approximate their current cost. For LIFO, a major shortcoming is that in a period of inflation, the costs allocated to ending inventory may be significantly understated in terms of current cost. Alright, so now the tax effects. As we know, the higher the net income, the higher the tax. FIFO gives us a higher net income, hence the tax will be higher. LIFO, we have a lower net income, a lower tax. Now, of course, for financial accounting purposes, we would like to show a higher income, and for tax purposes, we want to show a lower income. But here's the rub here, is that we need to select one costing method that will be used for both purposes. So in other words, we can't have the best of both worlds. The other thing is that we must use the costing methods consistently. So we just can't decide, all right, this year we'll use FIFO, next year we'll use LIFO, just to make things interesting. Can't do that. You have to use the same costing method from year to year unless you can justify that a change will better reflect the true financial position of your company. The other thing that I want to mention is that a company may have several different types of inventory. They do not have to use the same costing method across the board. They can use different costing methods for different types of inventory, but it must be used consistently. All right. Now, we've seen this before. On the balance sheet, inventory is classified as a current asset. So what we have is we have cash, we have accounts receivable, and then inventory. We also know that cost of goods sold is subtracted from sales in order to come up with the gross profit, and that our costing methods will have an effect on what the cost of goods sold and hence the gross profit will be. All right, one more item that we need to look at in terms of inventory. Consistent with the law of conservatism, which means that the accountants want to show the worst case or the less optimal case than the optimistic case. So, when the value of inventory is lower than its cost, and what we mean here is the acquisition cost, the company must write down the inventory to its net realizable value. When we talk about the net realizable value, or we can call it the market cost, it's what a company would have to pay for their inventory to replace it if the inventory was destroyed in a certain accounting period, whether it be fire or whether it's stolen or whatever. Alright, so here's an example. We have Kentuck TV has the following lines of merchandise. So flat screen, satellite radios, Blu-ray players, CDs, etc. Alright, so we're given the total number of units for each item, cost per unit, the net realizable value. We have to come up with the lower market or cost for inventory. So for each item we have to select which is lower, the cost or the net realizable value. So what they did for us, they put in red the lower cost. So in the case of flat screen TVs, we would take that net realizable value, which is lower than the cost, and multiply by the number of units. So then, as you can see, the total dollar cost of inventory is $155,800, and that is the number that would show up on the balance sheet. This concludes our lecture on Chapter 6 on the inventory costing methods, and of course there is a homework assignment that goes along with it. Why can't it be come on.
There.
Yeah, I'll be right there. You have to rename a chart.